The surge in oil prices is a particular area to keep an eye on. It comes at a delicate time for the U.S. economy. We saw a huge spike in the prices paid index of the ISM report just this morning, and the rise in core goods prices in the PCE on Friday, outside of COVID, was the highest since 1992. Our next guest warns that a stagflationary wind is starting to blow through the U.S. economy. Mohamed El-Erian is chief economic advisor at Allianz and the former CEO of PIMCO. Mohamed, welcome to you. We're going to hear from a series of key voices this hour, culminating with Jamie Dimon towards the end of the program. Just your response to what you've seen so far with Iran and what you think might happen from here.
So I think in terms of economics, a lot will depend on the duration and the spread of the conflict. The longer it lasts, the more it spreads, the more stagflationary it is for the global economy. Now, the good news is that this global economy has absorbed shock after shock after shock in the last few years and has proven incredibly resilient. But we don't want to throw too many shocks at it. So keep an eye on the duration of the conflict, because that is going to both fuel inflation, disrupt supply chains, and undermine growth at a time when policy flexibility is limited, especially for the Federal Reserve.
I look over at the 10-year yield, which, it was below 4 a little bit, but that was both on the blow-up of private credit and the initial flight to safety with Iran. Now that that's, kind of calming down to some extent, we see these inflationary reports, it's popping up again. The mortgage rate's back at like 6.15, something in that range. So what do you think happens with the 10-year? I mean, could we see it go significantly higher, back towards 4.5, even higher from here? Same thing with the inflation rate. I mean, I don't know what happens to the new Fed chair. Kevin Warsh is going to come in at a time when more people on Wall Street are saying maybe there's no more rate cuts this year.
Yeah, so there's a lot of uncertainty, as you pointed out. The immediate decision that the bond market had to make is, does it opt for flight to quality and safety and growth concern, or does it opt for inflation concerns? And it started opting for inflation concerns. We saw the 10-year move up 7 basis points, and then we got the strong ISM, and now it's up 10 basis points. So the bond market has mainly said, you know what, I'm more worried about inflation than I am about growth, than I am about flight to quality. Last week was all about financial instability, private credit, and also employment concerns. And that's why we went sub 4. So there's so many crosswinds. I think if you want to make a simplifying assumption, is we will mostly trade in a range of 4 to 4.5 unless we get a big financial issue.
Yeah.
And that financial issue would be some combination of the AI bubble and the private credit.